This is a presentation on exchange rate conversion. In dealing with exchange rate conversions, there are three major rates that we should understand. The first is the forward rate. This is the rate that has been agreed to exchange different currency at a specified future date. Then number two is the spot rate. This is the rate prevailing at a particular day. And number three is the closing rate. This is the spot rate obtainable at the end of an accounting period. Now, in translating financial statement, this usually occurs when businesses have subsidiaries operating in other countries where they use different currencies. And in preparing the financial statement, there's a need to translate the transactions that are taking place or that took place with the subsidiary, converting it to the parent company in currency to prepare the financial statement. And so one of the methods is the temporal rate, the temporal method, temporal rate or the temporal method. In this method, the trial balance is translated as follows. Non-current assets are translated at the exchange rate prevailing when the assets were purchased. Inventory and cost of goods sold are translated at the exchange rate prevailing when the goods were purchased. Other balance sheet items are translated at the closing rate. Sales and other expenses incurred evenly throughout the year are translated using the average exchange rate, which means the total exchange rate divided by 12. The owner's equity is reported at the prevailing value, and the gain or loss from translation is the balance sheet figure to balance the account. The second method is the current rate. It is when a firm is autonomous, we use the current rate to translate the balance sheet. The current rate is also known as the balance sheet rate or the closing rate. This rate is used to balance the balance sheet, balance all the items in the balance sheet, and the average rate is used to translate the income statement. Now, a quick illustration of how it works. A company located in Lagos buys goods from the United States. It ordered the goods February on credit, 50,000 naira. At that time, the exchange rate was 1 naira to 25 cents. And finally, on June 2nd, 2010, the firm made payment for the goods that purchased in February. But at this time, the exchange rate had moved to 1 naira to 20 cents. Now, this is the transaction. This is how the entries will be. When the purchase was made in February, the debit purchases 50,000 and creditors 50,000 naira. Then the dollar value, the debit purchases with 12 naira, 12,500. That's at the rate as at that time, which is 1 naira to 25 cents. So when that is converted, it gives us $12,500 and creditors. Eventually, when the payment was made in June, we debit creditor 12,500, which is what they are expecting, which is to balance off what we owe them. But in the real sense, what we actually paid is $10,000 due to the current exchange rate. So it means that we had a translation gain or an exchange gain of $2,500. This is because the exchange rate had gone down from 25 cents to 20 cents. 25 cents as at when we got it, but as at when we made our payment, it has gone down to 20 cents. So that gave us a gain of $2,500. So exchange rate conversion has to do with, or is required, this knowledge is required by companies who do transactions that has to do with foreign exchange, or who have subsidiaries that are located in countries where they use different currencies. Thank you.